Brent Freeman with the CBB Group. In this episode, we're going to discuss the four most common methods used when valuing a business. So if you're a business owner looking to sell or just looking to understand the value of your business, or a business buyer looking to acquire, stick around because I think it'll help you to understand the common methods used in valuing a business. As always, if you get something out of today's episode, please feel free to hit the like and subscribe button to help the channel grow. And if you've got questions, either simply just pop me a quick email or leave it in the comment section below and I'll get back to you as soon as I possibly can. So let's talk about business valuations. Now, business valuations done by a certified valuator, whether that's through your accounting group or through a certified business valuation company, which we are, really involves a pretty deep dive into the financials in your organization. And sometimes it's a little Greek as to the approaches that a valuator can present to you in that valuation. So in today's episode, I thought it would be a good idea just to review at a very high level the four basic approaches. And they are adjusted net asset approach, the capitalization of earnings, which is usually done on a historic look-back basis, or discounted cash flows to future earnings method, and then finally, the private company transactions or the market approach when valuing a company. Let's take a look at the adjusted net asset method. Now, I usually do this method first in a business valuation or even when I'm looking at putting a business to market. And the reason for that is when I look at the balance sheet, there are things that can jump out. And one of the adjustments to the balance sheet before we go through the calculations that we put together is to take out any non-operating assets or liabilities. So if you have a boat that's on the balance sheet, but it is not obviously a business-related expense or asset, and the liability associated with that, we'd remove those type of expenses from the balance sheet. The other things that you're looking for are excess cash. Now, I've seen businesses, and one that comes to mind recently is that they had sales of about $2.5 million, but they had $1.6 million in cash sitting on the balance sheet. Now, for the business to operate, they don't need that much money. They'd obviously had just left the cash in the company over a period of years. So we would reduce that amount of cash and remove the excess and then add it back at a later date. And the reason that's important is that when you go through the income and market approaches that we'll cover later, you would also add them back to the valuation. So we take the assets, we remove the excess cash or current assets from the business, we mark to market all of the assets. So if your equipment and machinery that you purchased for $1 million is now worth $500,000, we make those adjustments, remove amortization, depreciation, and any other items that really, if you sold the assets of the company, what would you get for them? So we then take the assets minus the liabilities, and with that, you get a bottom number. Now, to that final calculation, we would add back any of the excess cash, because obviously it's the company's, but you'd want to know what that looks like. So net asset adjusted value sets usually the floor or the lowest value in a valuation. And when you would use it, I use it on almost every transaction that I take a look at or valuation that I perform. But it's important to understand that floor value And you would use that traditionally if the business was struggling, had no cash flow, and or was going out of business. The next two valuation methodologies or approaches are around income. The first takes a look at historic cash flows of a business, and they're recast to either come up with an EBITDA or a seller's discretionary earnings. And then they're discounted or capitalized at a capitalization rate that the valuator is going to calculate. And that process is around going through and figuring out the risk associated with the business, converting that to a rate of return that an investor would look to get when purchasing or investing in the company. So in this situation, capitalization of earnings, it values the business based on the future earnings benefits that the business can expect. Again, what you're looking at is historical cash flows, and you're coming up with either an EBITDA or a seller's discretionary earnings that the valuator believes best represents the future cash flows of the business. Now, this can involve taking a look at kind of the maturity level of the business. A lot of times when I'm looking at a valuation of a business, I'm looking at owners that are maybe in their 50s or 60s, and they've grown the company to a point where they're comfortable. Now, obviously, the company could grow with additional capital, but you're looking at that historical pattern to take a look and see what cash flows that they've developed over a period of time that best represent the company on a go-forward basis. And to that, you're applying a capitalization rate, and that will then yield you value. The second approach under the income methodology involves discounting future cash flows to present value. And this really, think about this for a second. What's the value of having $1 today versus $1 5 years from now? So if you had an economic transaction go through today, the dollar would be worth $1, and that dollar 5 years from now you wouldn't pay $1 to get it, but what value or what amount of money would you pay to get that dollar? And that translates into a value. So in this case, the valuator's looking at a couple things. Could be that the company's a startup, maybe it's only 3 years old, they've invested in infrastructure, marketing, process, procedures, and they've gotten their cash flows up to a point where they're now predicting over a 3 to 5 year period a fairly decent increase in cash flows and revenue. Now, you can work through a model that will give you those cash flows, invested capital over a period of time, and return a present value of that future cash flow. And that's the exercise. Now, usually when I use this, I'm very conservative when I'm working with an owner. Most everybody I know, if you ask them to give you a 3 or 5 year projection of revenue on their company, can be pretty optimistic. So we kind of have to tame that down, and really working with the owner of the business, really go through a process. And that process involves year-over-year growth, revenue, costs associated with growing the business, either an increase or decrease in working capital, loans that maybe have to be repaid. So there's a pretty complicated formula that goes through this with this exercise. But with startups or companies that are just about to experience some pretty good growth, it's a good way to use and look at this method when valuing future cash flows of a company. Let's walk through an example of a discounted cash flows to present value, and it's a two-stage method. Now in this example, we had a 3-year cash flow projection in 2025 of $168,000, 26 of 329, and in 27 of 384,000. And those are discounted to net present value, which is the column on the far right-hand side of the sheet here. And that's, you can see, it adds up to a total of $494,000. So that's the first step. The second step is figuring out a terminal value, and a terminal value is the value of that cash flow projected going into the future beyond the 3 years here, associated with a growth rate. So we've been very conservative. We put a growth rate of 3% and then use the discount rate that we came up with on a separate formulation to project what that would be. In this case, it had come out to be the terminal value would be around $640,500, or the total indicated value, not including any excess items that we've taken off the balance sheet, of approximately $1.1 million. Now, I just want to point out that in this example, the valuation that we got using the historic or the capitalization rate was around $960,000. So although this value was higher, and you would expect it to be off of higher revenue forecasted in the future, it wasn't off by that much. The last approach that we're going to review is the private transaction method. Now, this values a business based on actual closed transactions of similarly held privately companies. And the data here is all of important. Usually when I'm looking at using this method or approach, my biggest obstacle is finding enough data to run a statistically valid model. And to do that, you need at least 5 to 7 data points that are pretty similar. And by similar, I'm talking about revenue size, amount of seller's discretionary earnings, or EBITDA. And if you can find that, you can run a pretty solid statistical analysis of what the market has been paying for those companies. So let's take a look at a valuation that I ran just a couple months ago, and we'll use that data set for an analysis. As you can see, there were 19 data points that I was able to gather on this valuation, and the mean price to revenue was 0.65, and the price to SDE in this case was 3.9. Now, using that number, let's see how it works with the company that I was actually evaluating. Using the mean price to SDE of 2.39 and the seller's discretionary cash flow that I established earlier in that valuation of $860, the value comes out to be $2,057,000. Now, that's a pretty good statistical analysis. And when I use that analysis and then compare it with, say, the discounted future cash flows or a capitalization rate on historic, which would be the 680 or 860 cash flow, you can kind of take a look to see how close they are and then make an adjustment on a final valuation. So there you have it, the 4 most commonly used methods or approaches that business valuators use when valuing a privately held company. The adjusted net asset, capitalization of earnings, discounted future cash flows, and private transactions on a comparable basis. And those 4 basic methodologies will probably be presented in most of the valuations that you take a look at. Now again, there's a lot that goes on behind the scenes to come up with these, but at a high level, understanding how these are put together may better help you understand the valuation and or have a conversation with your valuator or merger and acquisition advisor as you move forward. So I hope you got something out of this episode, and if you did, hit the like and subscribe. And with that, I'll see you on the next episode.